I'm Glenn Freeman for Livewire, and thank you for joining us for an income series interview where we're talking stocks versus property. I'm joined today by Steve Johnson, the CIO of Forager, and Chris Bates, who is an ex-financial planner who now runs his own mortgage broking firm. Gentlemen, thanks for joining us today.
Good to be here, Glenn.
Good to be here, Glenn.
Yeah, so what are the key distinctions that investors need to bear in mind in comparing direct property with investing in the stock market?
Yeah, look, and I want to caveat every single thing that I say today with a couple of more important principles than what we're talking about. I think people starting out early in life and spending less than you earn is absolutely the most important thing that you can do. And the second most important thing is that you invest whatever you're saving out of that in real assets. And by that, I mean assets that grow in line with the economy and in line with people's incomes. And I think whether it's property or shares, you can achieve those first two steps are far more important than whether you choose to do the rest through property or shares or through a combination of the two things. But jumping to your question, I guess that the key, I think, differences, and Chris can touch on a few of these for property as well, but the tax treatment of the two assets are quite different. You get a lot of tax advantages, I think, from investing in property that you don't necessarily get in shares, around negative gearing, around being able to deduct a lot of the operating expenses that you have with those assets. Obviously, we have the franking credit regime when it comes to shares, so that's an important benefit. Discounted capital gains in both assets, but with your primary asset in housing, you don't pay any capital gains tax at all. So I think the tax regime is probably favourable towards property here. I think a lot of the advantages, I guess, or key features of shares are that they're far more liquid. The frictional costs of buying and selling are much lower. You don't have stamp duty on shares. And if you decide you want to sell 50 BHP shares to go on a holiday, it's quite easy to do that and take that cash. You've got 2 days to wait for the cash to turn up in your bank account and you can go and do something with it. So I think they're probably the key distinctions is you're getting some tax advantages with one asset class. Chris, you might want to talk about the leverage component as well. I think that the main difference, particularly early in life, is that you can leverage property a lot.
And I think you're right, Steve. I mean, the key thing is at different stages of your life, you may want to use one tool over another. I mean, when I was a financial advisor, a lot of younger people, they're earning great money. They've finally decided to save their money. Your first point, Steve, a lot of them do spend everything they've got. Once they start to save money and they focus on that, they start to build up an asset base quite quickly, but it's still quite slow, right? You're still talking 50, 100,000. And, that's when potentially they may want to leverage that money because they've got great incomes. And that's when property is probably, best suited, with the younger people versus, someone who's coming in, thinking about retiring in 10 years time, or they're just retiring now. Property is a very lumpy, low yielding asset, which is your point, Steve. You can't just sell, a brick and go on holidays. And when you get into that retirement phase, you want income and liquidity and just because you're selling down your portfolio. So it's not one versus the other, but you're sort of missing a trick if you sit in either camp. If you sit in the shares are amazing, never buy property, to be honest, if you sat in that camp for the last 20 years, you would have probably wished you got access to property. You're missing out on massive tax-free growth on your home, and property markets perform very well. And vice versa, if you sit in just the property is the best camp, you basically can only invest when you can buy another property, and you're missing the opportunity with shares and diversification and building multiple asset pools for when you're in retirement. So it's not one versus the other, in my view. It's about using them both at different stages of your life. Leverage.
I think there's stages of your life, and sorry, just to add to that as well, there's just personality types. And I think a big mortgage early in life is a form of forced saving, especially with interest rates where they are at the moment. Most of your mortgage repayment is principal. So you're sitting there saying, well, actually, this is just forcing me to take a percentage of my income every year and save it. And I'm not going to be able to do anything else but pay that mortgage. Yeah. I've been able to build up a substantial amount of wealth without property, but I've been very, very disciplined about saying, okay, I would have paid this on a mortgage. I'm going to take that same amount of money and invest it in a stock portfolio. And I do it for a job. It's been my living. Our portfolios have outperformed the market by a lot over the past 20 years. So it hasn't been a negative thing for me to say I'm going to focus on what I know really well and invest in shares. But I'm the type of person who has the discipline to say, I'm actually going to do that. Whereas I think that the liquidity that we talk about as a positive with shares, it can also have negative problems as well. When someone wakes up one day and says, oh, I want to buy a new car and I'm just going to take these shares. And I know a lot of people that started investing in the stock market in their 20s, and the first time something came up that was a problem in life or a drama, if it's your mortgage, you just keep paying that, right? Whereas I think with the shares being there, being accessible, it's not necessarily a positive if you're trying to build wealth over 20 or 30 years.
Yeah, I think you're right. And I think that going back to that leverage point, that absolutely is a big driver behind the property market, right? When you want to sort of leverage into shares, yes, you can do margin loans. Yes, NAB have got an equity builder, but trying to leverage your money 10 times is very difficult, and you wouldn't have the guts to do it anyway, because any type of volatility in the market, you'd be under, and you'd be wanting to sell, and all the behavioral biases that play out in shares would take over, right? But in property,
or
people
forced
do it
to sell
day,
with a
right?
margin loan, you don't even have any choice a lot of the time. So I think that's a big difference. Sorry.
Absolutely. And I think with the property, what if you have 150,000, you can pretty much easily go and buy $1 million property and borrow 90% without a ridiculous mortgage insurance. So your 150 is now getting $1 million asset. And that's where, especially if it's growing tax-free, that's when you start to really, and your interest is basically your rents.
How does a diversified portfolio of Australian and international shares compare to owning a property, let's say in a metropolitan area for the same period of time?
You're saying a diversified a portfolio, right? You're just talking like a Vanguard, right? A Vanguard ETF. What's the market return? Not outperforming, buying small caps, etc., and trading the market and being professional. If you're comparing that type of return and the discipline around holding that investment, a lot of people stuff it up because the behavioral biases take over and they sell when they shouldn't be. So assuming you just hold an ETF and you ride it out for 10 years or 20 years, yeah, it's going to perform well, right? But you're going to be investing, unless you leverage it, you're going to be investing on a much smaller number. And so if you, for example, leverage that money into property, that can grow at a much smaller rate and still outperform shares quite significantly, especially if you take off the interest cost that you're paying and you minus off what you would have paid in rent anyway, because interest is exactly the same as rent. It's money that just goes. And so that's the problem with property, especially if you're leveraging it. Shares have to massively outperform the market, and you have to get into other asset classes rather than just large caps and just sitting and holding if you want to compete dollar for dollar on actual take-home return. Then you overlay the tax at the end of it. With a property, you don't pay any capital gains tax. Whereas shares, you're probably selling out and you're paying capital gains tax along the way. And you're actually, in terms of rebalancing your portfolio, you're paying capital gains tax.
So when you average that over a number of years, it probably works out about even.
If you look at the historical returns here, and there's plenty of data out there, but you've returned about 8% per annum from both asset classes over the last 50, 60, 70 years, pick whatever period you want. I think it's a dangerous time to be assuming that continues into perpetuity, because the last 20 years across both asset classes has been, for the first decades and decades of that period, my grandparents bought a house in Sydney in the 1950s, and house prices went up in line with income. So the multiple that you paid in line with incomes, and the same was true of the stock market. I mean, it's bounced around all over the place, but that 15, 14 PE multiple for the ASX has been pretty consistent over time. So the returns have come from companies growing those earnings. And when it comes to housing, the returns have come from people's incomes going up and then being able to pay more and more for houses over time. What's happened in the last 20 years is that those two factors have actually slowed down in terms of people's income growth and corporate profit growth in Australia, but the multiple has increased on both asset classes because interest rates have come down so far. So I think this past 20-year period, it's really important to recognize that is not representative of something that can go on forever. That tailwind can't be behind both asset classes. And I think people across the board should be expecting lower returns as a result of that. And then I think you've got to weigh up the leverage issue works both ways. I think at today's interest rates, it's hard to imagine a world where you can't earn a higher return than the 1.8 or 9% you might be paying on a mortgage. But there may come a world where you're paying 4 and 5% on your mortgage, and then the leverage works in your favor as long as you're making more than that 4 or 5%. But it doesn't if things are less than that.
I know there's this article that you wrote 1 or 2 years ago, which I think it was the Australian. You wrote it on, it was published on Livewire, or you wrote it for Livewire. which was talking about, your views on property, because at the time you weren't a property owner, and you were sort of quite, you were espousing that sort of a view that was probably might have been taken out of context to some degree, or run with a little.
Yeah, I don't think it was a view. It was a scenario for people to say, this is not the only way for you to retire rich. And the title of the article was How to Retire Happy, Rich, and Property Free. There are other paths here, but I actually think it's applicable to a pretty small percentage of the population. I think most people are better off. I'm going to pay off a house over my life. I'm going to retire. I own the roof that's over my head. And then there's not that much that can go disastrously wrong in life, right? If you've got a decent super nest egg put away and you own your own house, you're okay. But for the people that really don't want that lifestyle necessarily, and I think most people see it as a benefit, but some people do say, I actually don't want the hassle of living in the same place, the transactional costs of me moving. I like the idea of renting. I might like the idea of living overseas for 3 or 6 months every year. We're a pretty small percentage of the population, but my argument in that article was it is perfectly feasible for you to build up enough wealth to pay the rent on a very, very nice house in your retirement if you want, and not end up owning a property. It's possible, doesn't mean I would recommend it. And I just laid out the maths for people of saying, well, take your mortgage payments and do this with it. How much are you going to end up with at the end of your life?
And just to stay with you for just a touch longer, because the other point that you've raised when we discussed this yesterday, and you mentioned it earlier, is interest rates, and how big a part do interest rates play in the relevance or the comparison of stocks versus direct property?
Well, look, I think in terms of the value of property, we haven't, it impacts stocks. It doesn't impact it to the same degree. But I wrote another blog piece about this a few years ago. I don't think 99% of the population is walking around like me, making a financial calculation about how much they think a house is worth, what the rent would be on the same place. Most people walk into the bank and say, how much money will you give me? How much have I got? What's the best house that I can go and buy for the combination of those things? So the amount of money that banks are willing to lend people is a huge, huge driver of the average house price out there. The correlation between the two is more than 90% over the last 50 years. So I think that interest rate environment is a massive impact on the average price. We had a discussion yesterday, which is an interesting one, about the super premium end of the market. It's probably different because they're less reliant on bank funding. But I think all of those people that are doing what Chris is talking about, I've got a 15% deposit. How much will the bank give me? They're going out there and they're buying the best that they can get for that. So you've seen banks lend more money, property prices go up. It's been a pretty consistent relationship over a long period of time.
Yeah, and Chris, we'll hand the conch shell over to you again. What's your view on that, on the interest rate side of things, and how big a deal is that?
Obviously, it's massive, right? It takes common sense that interest rates drives human behavior, right? And if people can borrow at low interest rates and lower rates than they were yesterday, they're going to borrow more money. RBA have put out lots of reports on this showing how a 1% drop in interest rates boosts house prices by 30%. But you can take a very negative view on property and say what's happened, 10 years ago, Steve, you could have had that view on property, right? But look what's happened in property over the next 10 years, assuming migration goes over the longer term, assuming that there's capitalism. Income growth is not evenly spread around the economy. It's not a fair society that we have, right, where everyone gets the same wage rise. A certain pocket have had great income rises, and the number of people earning over 180,000 a year is much higher today than it was, 5 years ago. So I guess, when you're thinking about property, the big mistake people make is they just think just getting in the market is the thing to do, right? Just getting a property. But the problem is, like shares and companies, every single property grows at a different rate. And so the big mistake a lot of people make is they just go and buy a property and then they go and sell it 5-10 years later because they want to upgrade, and they're just hoping it works out, right? But the reality is, the properties that go up the most are something that are in scarce supply, and the demand that want them is the growing sort of demand that's got the biggest problem, which is the family market, and they don't want to rent. The reality is school zones are getting kicked out of rentals. They want that stability for their child, and there's not any options besides houses and, say, bigger apartments. And that's the things that you can't build any more of in these locations. And so Are those things going to change? Are we going to all of a sudden start building, knocking down houses in Mossman, or, in Rose Bay or Manly, to build lots of new townhouses? It's not going to happen, right? And so are we going to get population growth, and are they going to be the most desirable places to live? Yes. And so a certain fraction of the population is going to keep wanting to buy assets because they need to solve their family issue in these locations. And so interest rates absolutely will drive. The reality is interest rates, the talk of interest rates going up will be massive deflationary. The soon as, because you think about, you can look at the numbers, how much debt Australians have been going into. A lot of them are the younger consumers as well. And so if there's a talk of rates rising from, say, 2.5% to 3.5%, is that going to scare the hell out of consumers? Yes. And we're a consumer society. And so raising rates is going to be hard, right? And that's why a lot of the countries around the world haven't been able to rise rates. So if they do it, yes, they will do it, but it'll massively slow down our economy, which will then slow down the whole process as well. So, I mean, yeah, the reality is we could see rates low for a long time. I mean, everyone knows that, right? And if rates do stay low for a long time, property still seems a good bet versus renting, because of on current yields even. So that's the sort of long and the short of the interest rates. Can they go lower? Probably not. But can they stay low? Yes.
Now, the income characteristics, because this is the income series, maybe this is probably a question relevant for that younger, or perhaps it is for the older cohort as well. How do the income characteristics of direct property compare to that of the stock market?
I think income is very, very, very important to our valuation process. We do not buy a stock where we don't think that business is going to provide us with enough profits over its lifetime to give us a high return on our investment. So that's the calculation we're sitting there doing every single day. I buy this stock today. How much income is it going to pay me over its life? Now, a lot of what we do is say, well, okay, if we anticipate something here that this business is going to produce more income than people think, at some point that's going to be reflected in a share price, right? So we generally get most of our return out of the capital gain aspect of what we're doing, but we're trying to anticipate income that people aren't anticipating. This business is going through a cyclical downturn. Everyone's assuming it's going to earn these earnings forever, and we think it's going to be twice that. We're focused on the income, but we're also focused on a re-rating of the stock around that. Look, I think everyone would largely agree you're going to get a higher yield out of shares at the moment than you're going to get out of any sort of property portfolio. It's 3.5, 3.6 if you just buy the index. Fully franked, you gross that up, you're getting 4.5, 5 in taxable income every year. It's pretty hard to find any reasonable property that's going to provide you that sort of return after you take into account all of your costs. So it's an asset class from that perspective. And if you want to put together a subset of shares, true in property as well, if you want higher yield, you can buy particular types of property that are going to give you that. But certainly in the share market, it's not hard at the moment to get 5 and 6 fully franked if you're happy with less capital growth on the other side of the equation there. So I think the actual near-term income characteristics are probably in favour of shares.
And Chris, on that point, if or when interest rates rise, does property become less appealing for those income characteristics?
So just on the point around property income, property is not an income asset. It's a capital growth asset. You wouldn't, one of the biggest mistakes is what a property spruikers will do, will sell sort of positive cash flow properties and you can make money. But the reality is income's not a great thing with property because you can only deduct your interest and then whatever your profit is, you have to pay 40, 50% tax on it. Property, you should only be buying for capital growth. Hence why when you get to retirement, you don't want to buy a big lumpy property that's going to give you a yield of 4 or 5%. I'd much rather do what Steve's saying and have shares. I just don't think residential property, commercial is different, but residential property is an income play at all. It's purely a capital growth play. What you're trying to say is this property going to be more desirable in the future? And is it scarce? And who's going to want it? Are they earning good money and have they got money? And is that going to grow over time? It's pure demand and supply and a certain subset wanting it. So, I mean, that sort of answers the income side. Property is just not an income asset. In terms of rising rates, absolutely, that will slow the market down. We already saw that at the start of this year. Fixed interest rates started to jump. And we already saw appetite to take on big mortgages change. And so absolutely, when we start to see both variable rates and fixed rates starting to rise, that will absolutely slow down the market. But we know the problems that the RBA's got with the raising rates, right? They can't just, we want to get unemployment down. We want to get, wage growth. We want to keep our exchange rate, so there's difficulties for the RBA just to increase rates. And so will they slow down the market when rates rises come? Absolutely. But when do they happen, right? And you can sit on the fence and say it's next year or the year after, but it might not be, right? And that's what the problem with the bond market for the last 30 years. They're thinking rates are going to rise, but what's happened? So that's the big sort of elephant in the room is raising rates. But that's probably a good thing when the economy is doing that, right? You've probably got low unemployment and wage growth. And that's probably going to, slowly over time make property more as a multiple realistic. So hopefully
it's also true of the stock market. But to be really clear about it, nobody's paying $8 a share for Sydney Airport in an interest rate environment that's meaningfully higher than today. There's a lot of stocks out there that are priced for interest rates to stay low forever. The magnitude of it, I think, is probably less if you look at the overall indexes. But like I said earlier, the multiples that people are paying for the whole market today is higher than it was 10 years ago, because everyone's looking at the interest rates and saying, well, I used to want 6s in terms of that yield component from the stock market. Now I'm happy with 4.5, simply because what I can get in the bank is so much lower. So I think asset prices across the board are going down if interest rates go up, and that's just a simple fact of life.
And the other aspects are sort of related to that is the costs of, you don't need to paint your portfolio, you don't need to fix the plumbing or replace the rotting floor. Whereas that's something, maintenance and the costs ongoing is something I think a lot of people overlook in property. What's the wash up there between stocks versus property? Chris?
Look, every property's got different maintenance problems, right? You buy a lemon car, you're going to have a lot of problems fixing it up. So you can protect yourself when you go in with building a pest and understanding that. You hold it for 30 years, a property, absolutely problems are going to start building up. Different properties have different maintenance. A big sort of weatherboard, 5-bedroom house is going to be a lot more to maintain than a red brick building that's been around for 50 years, right? And it's managed by strata. So, absolutely you need to factor in the ongoing maintenance cost into your decision on what your ongoing costs are going to be with that property, and you have to minus it off your profit. That plus renovations, etc., a lot of the time aren't factored into property prices, right? And the growth that's seen there in terms of the market return. And so, yeah, but you shouldn't really want to be buying a property that you're going to have to start throwing money on sunk costs for things that just keep breaking down in the property. You try to protect yourself from those things up front.
I own a few stocks that take up a lot of my time and attention too, Glenn, and a few management teams that are taking a lot of cost out of a business that they shouldn't be taking out either. So it's not hassle-free running an active share portfolio, that's for sure. But look, I think, again, it's an area where there's probably not a lot of disagreement. Shares is a low maintenance investment. As long as you are sensible and careful and you go and buy the index, you don't really need to do much. You sit there and collect your dividends every year and you hope that it grows a bit over time, and that's all you need to do. It's got a lot of advantages from that perspective that are offset by some of the negatives.
One of the things with shares and property is if you buy a property and it goes up in value and you're earning a decent income, you can go back to the bank and pull out the deposit that you just paid for that property in an equity release loan. Very easy to do, right? So if you put 150,000 down to buy a property and that property goes up, you can then get your 150,000 back. And then you can negative gear that and buy your shares. So what you do is by doing them both, you basically build an asset base that you can redraw and then buy into shares. And so when you do it to shares, you can't re-leverage off them like property, right? And you have to potentially pay capital gains tax, etc. Whereas you can pull property profits out and then reinvest them very easy. And then you get a tax deduction on the interest for it, right? So that to me is a big benefit of doing property first, building a portfolio of quality assets. That's the key thing. And then start diversifying, then start building a share portfolio and paying off your non-deductible debt. So it's just a structuring thing a lot of people get wrong.
Sure. Any closing thoughts from you, Steve?
Yeah, one last comment from me. I think a lot of the argument, and this is true of both asset classes, but it's particularly true of property, is that the capital growth of the past is representative of what you're going to get in future. And I think we're at a very, very interesting inflection point globally around this re-rating of assets to higher and higher prices. And I think whether you're investing in the share market or you're investing in property, it's worth contemplating a scenario. It may not be the likely scenario, but I think it's worth contemplating a scenario of 20 and 30 years here of very, very placid asset price growth, if not the opposite, across all sorts of different asset classes. I think it's worth thinking about. And for me, the income that I generate off that share portfolio is some sort of protection against that, okay, if I don't make capital gains here, I am going to earn a return over the next 20, 30 years just from the dividends that they're paying. And I'm not sitting here saying that that's going to be any dramatic change next year. And I've had this concern for a long period of time and it's been wrong. So that's the caveat, but I do think it's worth people contemplating.
What an excellent place to leave it. Thank you very much, Steve. Thank you, Chris. Thank you for tuning in, viewers. And don't forget to leave your comments underneath. Thank you very much. Goodbye.
Thanks, Greg. Good to chat, Steve.
See you, Chris.